Well, hello and welcome. Thank you so much for joining me. Looking forward to presenting here to my subscribers on YouTube. And this is what I've been showing you guys recently, our retirement / long-term type trading, how we can effectively really start to cash flow high growth, fundamentally sound companies that can really produce incredible returns over the long term, and how to build insurance and risk management into the trades as well. So this is very low risk type trading, very conservative, much less risky than just buying a stock by itself. The difference between what we're doing here and simply buying a stock, hoping, praying and hoping it goes up, are worlds apart. And we're utilizing the power of options to really be able to generate an incredible strategy. Now, I'll talk a little bit about it later, but I refer to it as the money wheel strategy, and it's something that is very effective and something I've been using now for just over 2 decades. Very effective strategy, and what it involves is selling cash secured put options to get into a stock. Then once you own the stock, selling call options to get out of the stock. So selling put options to get in, utilizing a strategy that Warren Buffett utilizes, right? Where he will agree to buy shares at a discounted price and be paid day one. That's right, you can actually agree to buy a share at a cheaper price than what it's trading at and actually receive income premium day one for agreeing to do that. Sounds pretty incredible, right? In fact, this is what Warren Buffett did to acquire Coca-Cola shares. He utilized this same strategy. So for example, right, one of the trades that I'm looking at is with APPS. We'll look at our collar trade with APPS in a moment, but let me just show you this quickly and then we'll talk about the overall market. But you can see APPS here breaking above the 200. It did act as resistance. Now that would act as a support level, looking to move higher. So right now, the 200-day moving average is sitting around 70, where is it? 200-day moving average, 67.55, right? So the 200-day moving average is $67.55. What I'm going to do is I'm going to sell a cash secured put option at 67, just below that 200-day simple moving average support level. So what I'm saying here when I do this is I'm happy to own the shares at $67, but you're going to pay me day one for doing that. Sean, why on earth would someone pay you money to agree to buy the shares at a cheaper price than what they're trading at now? Why would someone do that? Well, think about this. One of the ways to understand this is if you had APPS shares and you wanted to have a guaranteed sales price on those shares, or you wanted to protect those shares by buying a put option, for example, right? So the person that owns APPS, they are happy to buy a 67 put option to protect their investment. Okay, but what we're doing is so that's why they do it. That's why they pay you, because they're paying you insurance to buy the shares at 67 if the stock does fall below that price at expiration. So what this is saying is I'll agree to buy APPS, good fundamentally sound company that I want to own anyway, right? I'll agree to buy it at 67. You're going to pay me $110 for every one option that I sell. And I'm agreeing to buy 100 shares. One option controls 100 shares. I'm agreeing to buy 100 shares at $67. And you're going to pay me $110 for every 100 shares I agree to buy. Okay. Now, this is for the next 17 days. Okay. So for the next 17 days, I'm looking to make a 1.64% return in 17 days on a very fundamentally sound company that I want to own anyway, but I'm going to get paid before I buy it. When people say to me, sure, I'm going to go out and buy this stock, I'll always say to them, did you get paid first? Right? You've got to get paid first before you buy a stock, and you've got to buy the stock at the price that you choose, not the market. I don't go in and just pay retail prices. Okay, I want to buy stock for wholesale prices and get it much cheaper than what it's trading at and get paid day one. So I'm agreeing to buy it at 67. If I sell one cash secured put option, then I'm agreeing to buy 100. If I sell 10, I'm agreeing to buy 1,000 and so on, right? So I'm agreeing to buy 100 shares here at $67. So $6,700. I need that in my account to buy the shares if I have to. Now, one of two things is going to happen. Okay, well, obviously you break even as well. If you're buying them for 67, you receive $1.10 per share you're agreeing to buy, your break even would be $65.90. So I'm agreeing to buy APPS stock at $65.90 when currently it's trading at $75.77. So one of two things is going to happen. It finishes above 67 come the 15th to the 10th, 17 days, or it finishes below. Only two things that can happen. Now, if it finishes above, I keep the $110 per contract of income and I don't have to buy the shares. That's it. If it stays above 67, which it clearly is right now, for the next 17 days, I keep the money, I don't have to buy the shares. If it does finish below 67, that's okay as well, right? I'm happy with that because I want to buy the shares anyway. So it's below 67, I still keep the $110 income, right, for one contract that I'm selling, one put option contract. And now I have to do what I said I was going to do. Buy the stock at 67 with a cost basis of $65.90 because I receive $1.10 per share. So either one of those scenarios I'm happy with, and that's what I'm looking to do on that particular trade. Now, the actual collar trade that we got into is working out very well. The stock, our break even for this stock, the cost for us is $56.70. This is on a separate trade, right? Where we set up a collar trade where you buy 100 shares, sell a call option, and buy a put option for protection. So current price is $75.77. All it has to do is remain above 60, which clearly it's well above that, for the next 17 days, and we are going to make a 5.3% return in a month. 5.3%. Very solid, very conservative, and a lot of downside built-in protection in this trade, and the ability to be able to manage these trades very effectively, whether it moves up or down. Okay, don't have time to talk about all the different ways to manage, but it's a very effective way of doing this. Now, the Palantir trade that we got into, you guys all saw that as well. Right now, the stock price is, let's have a look at Palantir. Palantir, 27.47. Okay, so that's the current price there. Still above the 21 EMA. It's looking fine. If it remains below 30 where it is now, that's fine. We'll keep the income for selling the call options, and we'll just sell another call option in November and another one in December and another one in January, right? So it doesn't really bother us if it stays below 30. If it does move above 30, we'll sell for a 7.5% return in a month. So either scenario, we're going to be happy. Right now, that stock's looking really good. Just continue to hold, right? That was the other trade that I showed you all. Now, a new position here for this longer term type account is on Snap. Now, Snap is a company here that is based in Santa Monica in California. It operates in the communication services sector, and the industry is internet content and information. Around 4,667 employees, and you can see the director and co-founders here and their actual pays as well, and that gives you an idea of who management is. Now, Snap, the company itself, operates a camera company in the United States and internationally. The company offers Snapchat, a camera application with functionality such as camera, obviously, communication, Snap Map, Stories, and Spotlight that enable people to communicate through short videos and images. It also provides spectacles. Now, this is an eyewear product that connects Snapchat and captures video from a human perspective. And advertising products. A large portion of their revenue comes from advertising, including AR and Snap ads. The company was formerly known as Snapchat, but it changed its name to Snap Incorporated in September 2016. The company was founded in 2010, and like we said, its headquarters are in Santa Monica, California. Now, this company has strong institutional investment. Over 997 institutions invest in this company. You can see Price Associates, $9.6 billion worth of the stock. Vanguard, $4.1 billion worth of stock. Morgan Stanley, who you would no doubt know, $3.7 billion worth of stock. BlackRock, one of the biggest institutions in the world, $3.2 billion worth of stock, and JP Morgan, 2.3, almost $2.4 billion worth of this company. So certainly smart money, institutional investment is involved in this company, along with solid mutual fund investment, as you can see there. So certainly smart money has invested heavily into this company. Now, growth estimates. What causes a stock to move higher? It's growing its earnings, right? Which then obviously causes people to buy it. That causes the stock to move up, but we want to be forward-looking. What are the growth estimates for this company forward-looking? Well, you can see here, over the next 5 years, you have to be forward-looking in the market. You can see over the next 5 years, per annum, they're looking at growth rates of 94.3%. This is very, very good. So very happy with that. Very good earnings. Their last earnings report was very good. They beat on earnings per share and revenue, and they grew their revenue 116.2% year over year. And then also their forecasted earnings growth for the next quarter was above what the analysts had expected. So good earnings report as well. Now, if we look here at the technicals, because we want the technicals to line up with the fundamentals. So if we just type in SNAP, we can see it's above all those key moving averages, the 200, the 50, and the 21. And if we have a look here at the price action, it has been consolidating in a trading range between $80 and $70 for quite some time now. It broke out of that last night, a little bit of weakness here, and we'll talk about the overall market in just a moment. But I still like this stock as a longer term type trade, right? So what I would say here, and you know, the other thing with Snap as well, is that a lot of their income comes from advertising. Around 88% of it is coming from the US. Now, they have around 158 million daily active users, and many of the analysts are now giving a price target on this stock of over $100. So, you know, that's a good thing as well. So, looking at all those things, let's now see how we would monetize this situation, and it would be something like this, right? So, we'll do a very conservative collar trade. That's what this particular, you know, area that we're looking at here does, right? This account does. It actually, you know, generates fundamentally sound growth stocks that we can generate returns from and very much look after ourselves on the downside with great built-in risk management. So stock right now is $80.08 entering today. Sell the out of the money 82 strike call option for the next 17 days, okay, bringing in $251 per contract of profit. We're also going to buy the 70 put option, okay, for the same expiry, the next 17 days for $56 a contract, okay. So what is a collar, Sean? You're buying 100 shares, okay, at the current price, okay, or multiples of 100 shares, could be 200, 300, 1,000, whatever, so long as it's in multiples of 100, you're going to sell the call option for income and buy the put option for protection. Those three components equal a collar trade, okay. So the cost basis to us, or our break even, is what we paid for the stock minus the call premium we brought in, adding back the insurance, because that's a cost. So $78.13 is what these shares will cost us. Now, only one of two things can happen. The stock can finish above 82 or it's below 82 in 17 days' time, right? That's it. If it's above 82, we have to sell the shares at 82. That's what we're saying when we sell the call option. We're happy to sell our shares at a higher price than what we paid for them. We would then end up with $387 of profit per 100 shares that we utilize the collar strategy on, okay? That 387 is made up of 251 with the call option, 192 with capital gain, right? You sell it for 82, you bought it for $80.80, so $1.92 difference, and then subtract the cost of the insurance, 56 cents. So if you divide what we would get if it finishes above 82 by what we paid for the stock, that would give you a 4.83% return in 17 days. So very solid return. Now, if it's below 82, that's okay as well. You still keep the $251, but you then own the shares and you sell call options against it for November, then December, then January, and so on, right? So that's the new trade there with Snap. Now, I do have another position here because, you know, let's look at the overall market first. I'll show you guys this. So overall market right now, we're in a neutral opening range mode here, okay? So we can see that what we do with this 92% accurate opening range on the SPX, we set the high and the low of the third Friday of the month, monthly options expiry, which is right there, and then we reset it again on the first trading day of the month. So right now with our opening range, we are neutral. As you can see, we're in between the two lines. If we break above 4471.52, we're bullish. The market is more than likely moving higher. If we close below 4427.76, we're bearish and we're likely to move lower. But as we speak right now, for the last couple of days actually, we have been neutral. So it's got a neutral market right now. Now, if we look here at the best snapshot, our workspace we call it, to get an idea of the overall market in one chart, you can see here that the Russell 2000 had a good day, right? 1.5% up above the 21, but still within a trading range, okay? Not really doing a lot. Transports did well last night, up almost 1%, just closed above their 21 EMA. Same with the industrials, they closed just above their 21 EMA, but not a huge day for them. S&P 500 did nothing, still neutral, and also tech was a little bit weak. Actually producing a doji here where there's little to no real body of the candle, this colored in bit, right? So this is an indecision candle here. If we close below that today, that's a bearish sign for the NASDAQ. If we close above it, and particularly get above the 21 EMA, that's a really good sign. Now, if we narrow down from the indexes down into the sectors, we can see the standout was energy. No doubt about that. Energy was up almost 4%. So that was a big day. Certainly retail did well also, up over 2%, and financials are looking pretty good. Little bit of weakness there in technology. Now, part of that is because we're starting to see, or we've already seen, the 10-year Treasury yield top 1.5% for the first time in 3 months. So that puts a lot of pressure on growth-heavy technology stocks like you find in obviously technology sector and the NASDAQ, okay? Now, when we go down and look at energy, which is up almost 4%, crude oil, natural gas and energy surged much higher. This is mainly due to the European energy crisis, which continues to get worse. So very strong move there in energy. I believe that will continue to occur. Also, don't forget, Congress is gearing up for a crucial week with votes on the $1 trillion infrastructure package, the debt ceiling coming up, that issue again, and also the debated $3.5 trillion budget reconciliation bill. So quite a lot going on this week. And economic news, we can see GDP, jobless claims on Thursday, petroleum status report on Wednesday. Today we've got consumer confidence that's coming out half an hour after the market opens, international trade in goods. And then later on in the week, we've got the manufacturing index and personal income and outlay. So quite a lot going on. GDP, they'll be certainly be looking at that. GDP, gross domestic product, the total economic output of the United States. So quite a lot going on here, right? As well as those things that I just mentioned. So in a neutral market, we're waiting to see what's going to happen. Now, for an opportunity, you guys let me know if you like me doing this, right? I want you to send an email to support@cashflowoptions.com.au with any feedback that you have, right? So let's look at energy, XLE. Now, one of the setups or edges that we use, Sean, what's an edge? Higher probability of one thing happening over another. What we do is we utilize something called a squeeze. Now, a squeeze is where you get the Bollinger Bands, these yellow lines, inside the Keltner channels, these purple lines. This only happens around 20% of the time. When this happens, it means that whatever it is that you're trading is building up energy. It's about to release that energy, either to the upside or to the downside. You can see that the Bollinger Bands were inside the Keltner channels, yellow lines inside the purple lines. Now they've just broken out as of yesterday. So we've got a squeeze that's now fired in the energy sector. And if you look at this stock that I'm looking to trade, which is LNG, you can see that's breaking out of a squeeze as well. So we've got the squeeze on the sector and the stock itself. If we look a bit closer at this potential idea, we can see that it was within a pretty good trading range here that you can see. It's broken out of that, taken out this resistance level here, and is moving higher. Now, 100 is a round number. It'll more than likely gravitate towards that. maybe not straight away, but we're talking several weeks here. In fact, to several months that we've got this to play out. I'm looking for it to get above 100 in the next several weeks and then move beyond, right? Very much like we did. Remember, I told you with Tesla, we're looking for that to get above 770, right? So again, this was a fantastic trade. Let's talk about Tesla. Remember, we set that up, right? I set this up with you guys in real time, okay? A lot of people are very good at talk and all the rest of it, but they never show you how they actually trade. Go on, show it to us in real time. Well, that's exactly what I did for all my subscribers right here. I set up Tesla with a call debit vertical spread. Right now, after 2 weeks, that is sitting at a 38% return. So again, I did this in real time. I showed you the entry. I showed you how I'd manage it. Right now, it's sitting at a 38% return. We bought the spread for $1,475. Right now, it's worth $2,038. Great profit on that. What I would say with the Tesla trade is just go ahead and take the profit. 38% return in 2 weeks is phenomenal. However, we're now utilizing that same strategy, but on a different stock, LNG. This is the way I'd set it up. I would do something like this. There it is right there. I would sell the 100 call for the 19th of November expiry, buy the 95, costing around $208 per spread, okay? Now, the maximum value of any spread is the difference between the sold and the bought strike. Sean, what's a spread? Well, you sell and buy an option at the same time. So we're selling at 100, buying at 95. The difference between those two is obviously $5. Minus what you paid for it, leaves you with $292 a contract, or 140% return on risk. Our break even, the buy strike price, 95, plus the cost of the spread, $97.08, just above where it's currently trading. What I'd do is I'd set a stop at $1.08, thereby I'm only risking $100 for one spread, and my potential profit is $292. That's almost a 3-to-1. So we're utilizing asymmetrical risk in our favor. So that is an energy trade that I'm looking to get into as well. Close out the Tesla trade for a huge winner, like I showed you guys, and APPS is going to be a huge winner. That's looking fantastic. I showed you that in real time. Palantir looks fantastic. I've got that in real time as well, right? So proving it to you, what we do works, and we're continuing to make money in the markets, whether they move up, down, or sideways. Now, what I'm also thinking of doing, because a lot of people have been asking me about this, is looking to get into, or create a program, should I say, that shows you my money wheel strategy, okay? Now, my money wheel strategy is where we sell cash secured put options to get into the stock, and then sell call options to make even more money to get out of the stock. And we just keep revolving the money wheel around like that. It's how Warren Buffett does it and many other of the top traders in the world. I want to show you this very conservative strategy that is certainly approved to be used within retirement accounts, longer term type trading, very effective, highly conservative strategy that can produce 5% returns per month, as I've been able to demonstrate to you guys here on YouTube in real time. What I'm thinking of doing, if I get enough feedback, is creating the money wheel program, where I show you how to find these great fundamentally sound growth stocks that are going to explode in value over the years, how to monetize those stocks, generate income every single month, and actually getting paid before we even buy the shares. I'll go into the detail of how you do that, how you manage the trades, and how this can be a hugely effective strategy that you can use for a lifetime, right? Fantastic way of trading, very conservative and very powerful as well. So if you guys want me to show you how to do that, how the money wheel strategy works, something I've used now for over 2 decades, send an email to support@cashflowoptions, all one word, cashflowoptions with an s.com.au. Send an email there, say, look, I just watched Sean's YouTube video. I love the sound of the money wheel strategy. Please put that program together. I would like you to do that. If enough people respond and they want me to do it, I will. If they don't, then I won't, right? Either way, it doesn't really impact me, but if you'd like me to do that, make sure you send your feedback to support@cashflowoptions.com.au and we can put together something like that for you. All right, my friends, I appreciate all of my subscribers listening here on YouTube. I look forward to talking to you all again next week. All the best, and bye for now.